Hi, everyone. This is Guy Paredes with Rockdale Financial Services here in New Jersey.
And Steve Richmond from Florida. Today, Guy and I are going to be speaking about uncharted waters and thoughts on a pandemic and current market conditions.
Absolutely. And first and foremost, Steve and I hope you and your family and friends are safe and healthy. And we want you to know we're thinking about you all daily. And we want you to know we're also here to help you every step of the way through this unprecedented crisis.
You know, Guy, I echo those sentiments exactly. And we are here to help. And we encourage you to call us and contact us at any time. As always, Rockdale is fully operational with our remote capabilities. We are providing video and conference call meetings on an ongoing basis for our clients.
Yes, Steve, absolutely. Since we do work with clients throughout the country, we have remote capabilities, and over the years, this has made it amazingly easier for us to work remotely.
We thought we would start out by giving you a little background, if you will, sort of the tale of the tape. Some of these facts you may or you may not be aware of. We all know that this pandemic is something we have never experienced in our lifetime in the United States. This pandemic has caused the fastest market correction in the history of our country. And that's a 10% drop off a high, which occurred on February 19th through February 27th. It was an 8-day occurrence. We also had the second fastest bear market decline in the history of our country, other than the Great Depression, which is from the high, a 20% drop on one of the major indexes. This happened from the high of February 12th through March 11th.
Right, Steve. And this is something neither of you or I ever experienced in our 45 years in this industry. And one example is in February of things that are going a little haywire is that the jobs report showed 278,000 new jobs and 3 months of record job growth. And then the Dow drops 900 points that day. That's kind of crazy.
Sure is. And then a new jobs report comes out in March of the 26th, showing 3.3 million Americans filed for unemployment that week, and the Dow goes up 1,200 points. I mean, that's never happened before. I mean, it's a bit unreal, wouldn't you say, Guy?
Oh, absolutely, Steve. And here's another few firsts that we've had. How about the 10-year Treasury bond hitting an overnight yield of 0.31%? That's less than 1/3%, and that's the lowest ever. And then on March 3rd, the 30-year Treasury drops below 1% for the first time ever.
Yeah, that's why we call these uncharted waters. Here's another unprecedented first, more uncharted waters. How about stimulus packages and liquidity from the Federal Reserve totaling over $7 trillion, Guy?
Yeah, Steve, those numbers are mind-boggling, and the Fed is also buying corporate bonds from the market for the first time ever, another first, as a support measure. And although there are many negatives by historical standards right now, suddenly the market could turn more positive, but we think we're likely not there yet. We think we really need to actively look for evidence, and we need to be patient, and we need to keep our emotions in check.
Absolutely, Guy. Let's talk about some of what we think we should be watching.
Absolutely. Let's do it, Steve.
So let's look at the financial crisis at the bottom of 2009. Okay. It's not the same per se, and perhaps history does not repeat itself, but sure it has some lessons to be learned. For example, the massive and monetary stimulus are and were necessary before the market bottomed out.
Oh, yeah, I would say that's true. But historically, that's not been enough to turn equities around and turn the outlook really for equities around in a bear market. We think attractive valuations should be in place first. For example, many fiscal and monetary measures were enacted in the spring and summer of '08 during the financial crisis, and yet equities didn't start their upward trend until the spring and summer of '09. Now that's instructive.
Sure it is. And we think the pandemic triggered event must have either passed or at least been materially mitigated. The recent sell-off was caused by a virus that is not yet under control. All indications are that they're not going to have a vaccine till the beginning of next year, earliest. So we would like this external shock to diminish a little, or at least see an end in sight before we get more bullish on equities.
Yes, Steve, I think that's right. You know, we don't know how long this pandemic is going to last at this point. But we think stocks can't be overvalued. Equities are more reasonable today because of the market drop, but they're still high by historical standards. Now, one measure to look at closely is the cyclically adjusted price to earnings ratio. Some of you may not know what that is, but it's commonly known as the CAPE, C-A-P-E, or the PE10 ratio, and that was developed by Nobel Prize winner Robert Shiller. And usually that's applied to the S&P 500, and it's defined as the price divided by the average of 10 years earnings. It's a moving average, and it's adjusted for inflation.
Yes, the Shiller Index is very interesting. It showed that in March, the S&P bottomed with a CAPE of about 21. And 21 is around the peak of markets. A ratio of 22 or higher would be considered overvalued by these metrics. During the recent market cycle from 2018 in January through February of 2020, the peak of the CAPE ratio was fluctuating around 30. During the last financial crisis, the bear market bottomed around 13, and other bear markets went as low as 10.
Yes, Steve, that's right. You know, with the CAPE ratio bottom this time at around 21, that's well above past bottoms. And that's something we surely need to keep an eye on. Another data point is credit spreads. Simply put, it's the difference between risk-free treasury bonds and corporate bonds. Recently, that spread has tightened, meaning the difference between interest rates on treasuries and corporate bonds is less. You know, this is somewhat neutral at this point, but based only on the Fed buying corporate bonds, and we don't know if that can last. Typically, we want to see a natural occurrence of this tightening. For example, lower quality bonds have a higher chance of defaulting, so they need to offer higher rates to attract investors to riskier investments. That's how you get a credit spread widening, and that's a more concerning scenario.
Yes, and the Shiller Index, as you said, is above the average. And right now, the fiscal and monetary policies that have been put in place has helped the bond market, but it's not a natural occurrence, which is what you're saying. Agree 100% with that. We are also seeing some data collapsing, like quarterly earnings and projections, and the decline in energy markets, Guy. I mean, economic data should be expanding or at least contracting less. We have only started to see the corporate earnings and projection numbers. Again, for a more positive outlook, we should be past the point of maximum bearishness and the earning numbers to be slowing. Earnings have normally lagged a rebound in equities at the end of bear markets. So again, we would like to see the pace of the contraction at least slowing.
Yeah, I agree, Steve. That would be another good sign. And I would add to that, many companies have muddy forecasts and guidance going forward, and some are not even giving guidance at all, which is normally expected by stockholders.
Right.
And that's because companies can't see through the fog just yet. And another factor is investor sentiment. And normally you would look for that to reach a low point first as an indication that we've hit the bottom.
Right.
It may be hard to measure. You know, you could look at the trading volume and equity fund outflows and so on. Given it an example, investors pulled out over $326 billion from mutual funds and exchange traded funds in March. And that's more than 3 times the outflow during the bottom of the financial crisis in October of 2008. Now, that has slowed down some this April here, but we'll see.
Yeah, but those numbers are still huge, Guy. And there's other numbers like unemployment numbers that continue to increase, right? That, along with wage cuts for many of the people that are still employed, will definitely affect consumer sentiment and make consumers more cautious about spending. Wouldn't you agree, Guy?
I totally agree with that. You know, we don't know what the consumer is going to look like on the back end of this. So overall, while we're going to miss maybe some, you know, we don't know, but we may miss some upside opportunity here. We could very easily have more pullbacks and more pain ahead. And you know, the challenge is that there's a very wide disparity in potential outcomes here because of lack of clarity. And, you know, as the saying goes, patience is a virtue, and this may not be ever more important than it is now.
Agreed. Amen. I mean, that's really, really important. So by studying these factors, right, and indicators, you know, we're going to continue to analyze market conditions, right? And we're going to pursue logical, periodic reinvestment programs to take money from fixed equity positions and cash positions and move them back to equity positions. However, in the meantime, you, our client, are the ultimate decision makers. And therefore, we will accommodate either a more aggressive or more conservative stance based on your direction. So we encourage you to call us at any time, and we provide guidance and help regarding your thoughts.
Yeah, absolutely, Steve. And in conclusion, I would say we want you to know we're absolutely out here looking out for you, and we appreciate you. And we'll always do our best to, you know, make sure that you are up to date with everything that's going on in the markets. And Steve and I and all of us at Rockdale are confident we're going to get through this crisis, as America always has throughout its history. And as always, we're constantly evaluating opportunities in an ongoing effort to both enhance and protect your overall financial health. You know, we do understand this pandemic has caused concerns, but we hope this information's been helpful and it gives you some perspective. And of course, as all our clients know, we always make ourselves available to you at any time. And with that, I'll wrap up and just say, you know, we hope you and the ones you love continue to stay healthy and safe during this crisis.
Could agree more, Guy. I just add one more quote to that. And that would be a Warren Buffett quote that said, never bet against America. Because America always wins, and we're going to win. We're going to get through this. We look forward to getting back to some sense of normalcy and then getting to see you in person. So we wish you and your family all the best. So take care, everyone, and stay healthy and safe.
Stay healthy, and stay tuned now for the required disclosures, as we're required to do with any of these webcasts. And Securities and Advisory Services offered through Cetera Advisors LLC, doing business. They also do insurance business in California as CFGA Insurance Agency LLC, and are a member of FINRA and SIPC, and a broker-dealer and a registered investment advisor. Some advisory services also offered through Rockdale Financial Services, Inc., a registered investment advisor. Cetera is under separate ownership from the other named entity. Investors cannot directly invest in indices. Past performance does not guarantee future results. Investments in securities do not offer a fixed rate of return. Principal and yield and/or share price will fluctuate with change in the market conditions. And when sold or redeemed, you may receive more or less than you originally invested. No system or financial planning strategy can guarantee future results. And end of disclosure. Thanks again.
Take care, everybody. Good luck.
Bye now.